The wrong fight. Why markets reward temperament over intelligence. Flint West reporting. They told you markets were an intelligence test. Learn accounting, study economics, understand valuation, build better models, read more research, find the edge, get smarter. And if you could somehow know more than the guy sitting across the table from you, eventually you would take his money. There is only one problem. That may be the wrong fight. Because once you know enough to understand what you are doing, something else starts determining whether you actually make any money. Temperament. Markets are mathematically describable, but they are psychologically experienced. And those are two very different things. Take Bitcoin. You have $1,000. Bitcoin is trading at 70,000. You believe it reaches 150,000 within 24 months. And you know perfectly well that somewhere along the road, it could fall 50%. So the mathematics looks easy. Buy $1,000 of Bitcoin and wait. If you're right, you more than double your money. Beautiful. Except Bitcoin doesn't go straight to 150,000. It goes to 35,000 first. And now your $1,000 is worth 500. The thesis might not have changed. The mathematics might not have changed. The destination might not have changed. But something has changed. You, at 70,000, you were an investor. At 35,000, you're staring at the ceiling at 3 in the morning wondering whether you've made a terrible mistake. Same asset, same thesis, different human being. And that is where position sizing suddenly becomes much more interesting, because there are actually two kinds of survival in markets. There is financial survival. Can your portfolio survive the drawdown? And then there's psychological survival. Can you? Those are not the same question. You may have enough money to withstand a 50% drawdown. That doesn't mean you have the temperament to sit there and watch it happen. Which means position sizing isn't merely a mathematical calculation. It is psychological engineering. A 50% collapse in an asset that represents 5% of your wealth is unpleasant. A 50% collapse in an asset containing everything you have feels existential. Same market, same percentage decline. Completely different psychological experience. Position sizing controls the volume. It determines how loudly the market can scream inside your head. And suddenly, Mike Tyson starts sounding like a portfolio manager. Everyone has a plan until they get punched in the mouth. Well, markets punch people in the mouth for a living. A crash, a margin call, 6 months underwater, a terrifying headline. Everybody else getting rich while your position goes nowhere. Your highest conviction trade suddenly looking completely insane. That's the punch. And that's when the market discovers whether you actually own a strategy or whether you merely owned one while it was comfortable. Warren Buffett understood this decades ago. Once you possess ordinary intelligence, what matters enormously is having the temperament to control the urges that get everybody else into trouble. Think about what that means. There is a point beyond which additional intelligence starts delivering diminishing returns. But poor temperament can still destroy everything. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. A brilliant investor with terrible temperament can overanalyze, overtrade, add leverage, fight the market, panic at the bottom, chase at the top. And because they're intelligent, they can construct extraordinarily sophisticated explanations for every stupid thing they're doing. Intelligence becomes the lawyer for emotion. That is the clever trap. Meanwhile, somebody with no Bloomberg terminal, no macro model, and no sophisticated understanding of market microstructure can buy a broad index every month, avoid leverage, ignore financial television, and compound wealth for 30 years. They know less, but they interfere less, and sometimes that is enough. Because insufficient intelligence may limit your edge. Insufficient temperament can prevent you from monetizing the edge you already have. Now, there is an important qualification. Temperament cannot rescue stupidity. If your strategy has negative expectancy, calmly executing it doesn't make you disciplined. It just means you're going broke professionally. You still need a genuine edge. You still need competent analysis. You still need mathematics. But once those things exist, another bottleneck appears. Can the human being actually execute them? And this is where the argument takes another turn. Maybe the solution isn't becoming emotionally bulletproof. Maybe the solution is building systems that don't require you to be. Automatic investing, position limits, systematic rebalancing, predefined exits, algorithmic execution, passive vehicles, rules established while you're calm that govern your behavior when you're not. In other words, don't just train the human, engineer around the human. But even that only gets you so far, because you can switch off the algorithm, cancel the automatic purchase, break the position limit, redeem from the fund, abandon the strategy. The human hasn't disappeared. You've simply moved them further away from the button. And perhaps that's the real objective, not eliminating temperament, but minimizing the number of moments when your financial survival depends upon possessing extraordinary amounts of it. Because humans are not naturally built for modern financial markets. Our instincts tell us that when danger appears, we should act. Markets frequently demand the opposite. Do nothing. Wait. Accept uncertainty. Watch losses without panicking. Ignore the crowd. Delay gratification. Remain inactive while every nerve in your body is screaming at you to make the pain stop. That is not normal human behavior. It is trained behavior, or engineered behavior. Which brings us back to the beginning. Maybe we've spent decades teaching people how to become smarter investors, better models, better forecasts, more information, more analysis. When after some minimum level of competence, the larger advantage may come from something completely different. Building a strategy that the human nervous system can actually survive. Because the mathematically optimal strategy is worthless if the person executing it cannot stay inside the trade. And that means the real question isn't simply, are you right? The real question is, can you remain right long enough for the mathematics to pay you? Maybe intelligence gets you into the fight. Maybe mathematics gives you the plan. But temperament determines whether you're still standing when the bell rings. And if that's true, we've been training for the wrong fight. Flint West, signing off.